India's new budget is making waves. They're aiming to boost consumer spending and fuel economic growth, all while keeping a tight grip on their finances. It's ambitious, to say the least. We're going to unpack how they plan to pull it off using a fresh report from Morgan Stanley Research called F2026 Budget, Boosting Consumption and Capex, published just a few days ago on February 3rd, 2025. By the end of this deep dive, you'll have a clear picture of this budget's goals, the strategies involved, and what it might mean for different sectors of the Indian economy.
What's intriguing here is how India is attempting to balance growth with fiscal responsibility. It's a bit of a tightrope walk.
Let's break that down. The report emphasizes India's commitment to what's called fiscal consolidation, aiming for a fiscal deficit of 4.4% of GDP, which is lower than anticipated.
It certainly signals the government's confidence in managing its debt. They've even set a goal to reduce it to 50% of GDP by 2031.
That's a pretty aggressive target. Does Morgan Stanley think it's achievable?
They do have a bit of skepticism about one aspect, achieving the projected 14.4% growth in income tax collection, especially given the significant income tax cuts in the budget.
So we have our first tension point, reducing the deficit while also cutting taxes to encourage spending. How does that add up?
Well, the budget includes a massive INR 1,000 billion in income tax cuts, primarily benefiting those with low and middle incomes. The idea is to stimulate the economy by giving people more disposable income, which in theory should lead to increased spending.
That makes sense. But if the goal is to boost consumer spending, wouldn't that usually mean cutting back on other types of government expenditures?
Not in this case. The budget actually prioritizes capital expenditure, or Capex, alongside those tax cuts.
Now, this is where things get interesting. The report points out a 17.4% growth in effective Capex. Could you explain what that means?
Effective Capex is a broader measure than just direct spending by the central government. It also includes grants given to states for infrastructure projects, painting a more complete picture of investments in those long-term assets that are so crucial for a growing economy: roads, bridges, power plants, and so on.
So they're taking a two-pronged approach, boosting spending in the short term while laying the groundwork for long-term growth. What's Morgan Stanley's view on this strategy?
They view the spending quite favorably, especially because a large chunk of it is directed toward areas like water, health, education, and rural development. Investments like these have the potential to boost both economic output and quality of life.
It sounds like they're trying to strike a balance between immediate impact and lasting improvements. But besides fiscal discipline, tax cuts, and increased Capex, is there anything else that stands out in terms of the budget's overall strategy?
Yes, India has outlined a long-term development vision called Viksit Bharat, which means developed nation, and it centers around four key drivers of growth. They call them the four engines.
4 engines, you say? I'm intrigued. Let's take a closer look at each one. What's the first engine?
The first engine is agriculture. The budget focuses on increasing farmers' access to credit, developing high-yielding seeds, and specific initiatives to improve both cotton farming, which is a major cash crop, and pulse production. These are essential for India's food security.
This focus on high-yielding seeds is critical. Not only could it boost farmers' incomes, but it also addresses India's need for greater food security as the population grows. It's a smart move that tackles multiple challenges at once.
Exactly, and that ties into rural prosperity, which is essential for balanced growth in India.
What about the second engine? What's powering that?
The second engine is focused on micro, small, and medium enterprises, or MSMEs, often considered the backbone of any economy. The budget proposes several initiatives to support them.
Speaking of job creation, the MSME sector plays a crucial role in India's economy. What does the budget offer for these businesses?
Firstly, they're revising the guidelines for MSME classification, expanding their access to credit, and implementing various schemes designed to strengthen this vital sector.
What specific areas of the MSME sector are they targeting?
Sectors like footwear, leather, toys, and food processing are highlighted in the report. These are known for generating employment, especially in rural areas, so the impact could be significant.
So they're aiming to boost manufacturing, create jobs, and stimulate economic activity.
Yeah.
All while strengthening these crucial small businesses. Very strategic. Okay, what about the third engine? What's driving that?
That would be investment, both social and economic.
Could you elaborate on that? What exactly does that entail?
On the social side, the budget emphasizes developing education and healthcare infrastructure. For instance, they're expanding the renowned Indian Institutes of Technology, IITs, known for producing top-tier engineers and scientists, and creating more centers for skills development.
So investing in human capital to prepare for the future. That makes sense. And what about economic infrastructure? What does that look like in practice?
It encompasses areas like water, which is crucial given the country's water scarcity challenges, power generation and distribution to keep the economy running, and even nuclear energy, indicating a forward-thinking approach to diverse energy sources.
Wow, so they're really looking at the long game, tackling immediate needs while investing in solutions for the future. We've covered agriculture, MSMEs, and investment. What's the final engine driving Viksit Bharat?
The fourth engine is exports, a key area for India's continued economic growth.
Interesting. India has been working to boost its exports for a while now. What stands out in this budget that's new or different?
There are a few things. The budget emphasizes streamlining international trade processes, making it easier for businesses to access credit for export-related activities, and upgrading infrastructure related to exports, particularly air cargo.
It sounds like they're making a concerted effort to make Indian businesses more competitive on the global stage. Now we've discussed the four engines of growth in detail: agriculture, MSMEs, investment, and exports. What does all this mean for India's overall economic outlook? What are the potential macro implications?
Morgan Stanley seems to be cautiously optimistic, seeing a lot of potential in this approach, but acknowledging that risks and challenges exist as well.
That's fair. Let's start with the positives. What aspects of the budget are they most optimistic about?
They believe that the combination of tax cuts to stimulate consumer spending and the government's focus on Capex could lead to a virtuous cycle of growth.
A virtuous cycle. So more spending leads to more investment, which in turn fuels even more growth.
That's the idea. And they project that India could potentially achieve a sustainable growth rate of 6.5% if everything goes according to plan.
That's a pretty impressive growth projection. But you mentioned challenges as well. What are some of the potential downsides or risks they highlight?
As we've discussed, a budget is just a blueprint. Success depends on effective implementation. The government needs to deliver on those ambitious Capex plans and ensure that income tax collection stays on track despite those cuts.
So execution is key. A solid plan is one thing, but putting it into action effectively is another challenge altogether.
Precisely. And of course, external factors like a global economic slowdown are always a risk that could impact India's economic trajectory, no matter how sound their domestic policies are.
Right. Unforeseen circumstances can always throw a wrench into the works. So a lot to be optimistic about, but also some potential hurdles to overcome.
Exactly.
Now, one last piece of the puzzle before we move on the investment outlook. We touched on this earlier, but what's the report's overall take on investment in India in light of this new budget?
Morgan Stanley remains positive on Indian equities, particularly those categorized as small and mid-cap stocks, or SMID stocks for short. They believe these companies are well-positioned to benefit from the anticipated growth in both consumption and Capex.
So they see a lot of opportunity for investors there. And this is because smaller companies are often more directly tied to domestic economic growth.
Exactly.
Is there anything else they highlight in terms of the investment landscape?
Yes, they are also optimistic about the potential for increased foreign direct investment, or FDI, and a generally improved outlook for private investment in India.
What's driving that optimism?
The various tax reforms included in the budget play a significant role. And they also hint at the introduction of a new tax code in the near future, which could further enhance the investment environment.
So a lot of potential positives on the investment front as well.
Indeed.
Now, I know you mentioned earlier that Morgan Stanley has some reservations about the projected income tax collection growth. Could you elaborate on that a bit more?
Certainly, the government is projecting income tax collections to grow by 14.4% in F2026, which is quite ambitious, especially considering the significant income tax cuts we discussed earlier.
It seems like a bit of a paradox, doesn't it? Reducing taxes while expecting higher collections.
It does. Their projection seems to rely on the assumption that the tax cuts will stimulate economic growth to the point where the overall tax base expands dramatically.
So they're banking on a rising tide, lifting all boats, so to speak. Does Morgan Stanley buy into that?
They're a bit skeptical. They believe the government's assumptions might be a bit too optimistic, and that achieving that level of income tax collection growth could be more challenging than anticipated.
So it's definitely something to keep a close eye on as this budget is implemented.
Absolutely.
All right, we've covered a lot of ground here. We've explored the budget's key goals, analyzed its strategies, and delved into its potential implications. But before we move on, let's take a moment to distill some key takeaways for you, our listener, to ponder. What are some of the most important points we've covered so far?
We'll be back in a moment to do just that.
We've been examining India's ambitious budget and how it balances growth with fiscal prudence. But as we all know, the devil is in the details. So let's dive into some of the specifics from that Morgan Stanley report.
Let's start by examining India's projected finances for the current fiscal year F2025. Interestingly, the government has revised its fiscal deficit target for this year, bringing it down slightly to 4.8% of GDP.
So they're already demonstrating a commitment to fiscal discipline. Even before the new budget takes full effect, it's still a bit higher than the 4.4% target for F2026, but it shows they're taking that consolidation seriously.
Indeed. However, Morgan Stanley does flag a couple of points that warrant attention. They've observed that the growth assumptions for direct taxes, especially corporate taxes, seem a tad optimistic.
Considering the tax cuts aimed at boosting consumer spending, that's understandable. What's the other area they're watching?
They're also looking closely at the total expenditure growth assumptions, which seem heavily reliant on achieving the projected growth in Capex.
So a lot hinges on the government's ability to execute those infrastructure projects efficiently and effectively. Makes sense. Now let's shift gears to the F2026 budget itself. What do the projected numbers look like?
The government is projecting total revenue receipts of INR 34,204 billion, which represents a 10.8% increase over the revised estimates for F2025.
That's a pretty substantial increase. Where is that growth primarily coming from?
They're anticipating an 11% growth in gross tax revenue, with both direct and indirect taxes contributing to that increase.
And what about non-tax revenue? What's the outlook there?
Non-tax revenue is projected to grow at a more moderate but still healthy rate of 9.8%. Morgan Stanley attributes this to the expected resilience in dividends and profits, particularly from public sector enterprises and the RBI.
Okay, so the revenue side of the equation seems to be on track. What about spending? How does that break down in the projected budget?
The total expenditure is projected to be INR 50,653 billion, a 7.4% increase over the previous year. And as we've discussed, the emphasis is clearly on Capex. They've allocated INR 11,211 billion for capital expenditure, with effective Capex, including those grants to states, reaching INR 15,483 billion.
So a significant portion of the budget is dedicated to building for the future. It's interesting to see how this aligns with their long-term vision for a developed nation.
Absolutely. The report also indicates a projected moderation in the share of revenue expenditure in GDP, although it's still expected to grow at a rate of 6.7%. This includes a notable allocation for grants to states specifically for capital asset creation.
It seems like they're really trying to stimulate infrastructure development at both the central and state levels, creating a more comprehensive approach.
That's right. The report also highlights the government's anticipation of a continued decline in subsidy expenditures, which should contribute to their fiscal consolidation goals.
That makes sense. Lower subsidies mean less strain on government finances, freeing up resources for other priorities. Now let's move beyond the broad strokes and zoom in on some of those four engines of growth. What specific measures are they taking to make those engines roar?
Let's begin with agriculture. The report highlights several initiatives designed to enhance productivity and boost rural incomes. One key area is the increased focus on credit availability for farmers through the Kisan credit card scheme.
So ensuring farmers have the financial resources they need to invest in their operations, adopt new technologies, and ultimately increase their output.
Precisely. They're also promoting the development and adoption of high-yielding seeds, a crucial element in boosting crop output and improving food security.
And that ties back to their emphasis on self-reliance and pulses, which are an essential source of protein for a large segment of the population. Addressing nutritional needs alongside economic growth is a smart move.
Absolutely. The report also mentions targeted initiatives aimed at improving the productivity and sustainability of cotton farming, another major cash crop for India. It's a comprehensive approach to agricultural development.
Now let's talk about the MSME sector, which plays a crucial role in job creation and economic vibrancy. What steps are being taken to support these vital businesses?
The budget includes several measures, beginning with the reclassification of the investment and turnover guidelines used to define MSMEs.
Why the change? What's the rationale behind that reclassification?
It seems they're aiming to create a more level playing field and ensure that businesses aren't discouraged from growing beyond a certain size. Due to the fear of losing benefits associated with MSME status, it encourages growth and dynamism within the sector.
That makes a lot of sense. A healthy and dynamic MSME sector is crucial for overall economic growth. What other measures are they taking to support these businesses?
They're expanding access to credit for MSMEs, particularly micro enterprises, through customized credit card schemes. And they're launching new programs specifically designed to support first-time entrepreneurs.
So nurturing a culture of entrepreneurship and innovation, that's a key ingredient for long-term economic success. What about access to financing beyond those credit card schemes? Are there any initiatives to address that?
Yes, there's a strong emphasis on strengthening the credit guarantee system for MSMEs and startups. This essentially reduces the risk for lenders, making it easier for these businesses to secure financing. It's about making the system work for them, not against them.
That's a crucial step in empowering these businesses to grow and thrive. Now let's move on to the broader topic of investment. As we've discussed, this budget prioritizes investment in both people and infrastructure. But what does that look like in practice? What specific examples does the report highlight?
On the social infrastructure front, the report emphasizes investments in education and healthcare. They're expanding the network of Indian institutes of technology, those renowned IITs that produce top-tier engineers and scientists, and they're creating more skilling centers to equip the workforce with the skills needed for the jobs of the future.
Investing in human capital is essential for any economy that wants to remain competitive in the long term. And it sounds like they're not just focusing on high-level skills, but also addressing the need for a skilled workforce across various sectors.
Exactly. And there's also a focus on expanding access to quality healthcare, including specialized facilities like daycare cancer centers.
So they're investing in people's well-being alongside their skills, recognizing that a healthy population is a productive population. What about economic infrastructure? We touched on that earlier, but are there any specific areas highlighted in the report?
The report specifically mentions investments in water management systems, crucial given India's water scarcity challenges, power generation and distribution, which are essential for keeping the lights on and the economy running smoothly, and even support for developing nuclear energy.
It sounds like they're taking a multi-pronged approach to energy, addressing both immediate needs and long-term sustainability.
Precisely. And lastly, they're allocating funds and providing fellowships to encourage research and development across various sectors, recognizing that innovation is a key driver of long-term growth.
It's encouraging to see that they're not just focused on building physical infrastructure, but also investing in the kind of intellectual capital that will drive innovation in the years to come.
It's about creating a fertile ground for new ideas and technologies to emerge.
We've now covered 3 of the 4 engines of growth: agriculture, MSMEs, and investment. Let's wrap up this section by exploring the 4th engine: exports. What specific initiatives are they focusing on to boost India's presence in the global marketplace?
One key area is improving access to credit for businesses engaged in export-related activities. They're also streamlining the processes involved in international trade, cutting down on bureaucracy and red tape to make it easier for Indian businesses to operate on a global scale.
Reducing those administrative burdens can make a huge difference for businesses trying to navigate the complexities of international trade. What else is on the agenda?
They're developing digital public infrastructure specifically designed to support international trade and integrate Indian businesses more seamlessly into global supply chains.
So leveraging technology to make Indian exports more competitive and efficient. What a great example of how technology can be a powerful tool for economic growth. What about promoting specific areas of expertise?
The report highlights efforts to guide states in promoting the establishment of Global Capability Centers, or GCCs. These centers are essentially hubs of expertise that provide services to multinational corporations. They're encouraging states to set up these centers in Tier 2 cities, which could lead to more balanced regional development.
That's a smart move. Spreading economic activity beyond the major metropolitan areas can have a ripple effect, benefiting a wider range of communities. And let's not forget about the physical infrastructure that underpins successful exporting. What are they doing on that front?
They're investing in upgrading infrastructure and warehousing facilities, particularly those related to air cargo. Recognizing that efficient logistics are crucial for getting those exports out the door and into the global market.
It all comes down to creating a system that supports businesses at every stage of the export process, from financing to logistics. Now we've delved into each of those 4 engines of growth: agriculture, MSMEs, investment, and exports. What does all this mean for the bigger picture? What are the potential macro implications of this budget?
Morgan Stanley offers a cautiously optimistic outlook, recognizing both the potential and the challenges that lie ahead.
We've heard that phrase before, cautiously optimistic. What does that translate to in this specific context? What are they optimistic about?
They believe that this combination of measures, stimulating consumer spending through tax cuts and fostering growth through investment, could create a solid foundation for broad-based economic expansion.
So a positive feedback loop where growth begets more growth.
Exactly. And they project that India could potentially achieve a sustainable growth rate of 6.5% if everything falls into place.
That's an impressive target. But we know there are always challenges to overcome. What are some of the potential hurdles they highlight?
The biggest unknown is effective implementation. A budget is just a plan on paper. The real test is in translating those plans into tangible results. Can the government deliver on those ambitious Capex projects? Will income tax collection keep pace with projections despite the tax cuts?
Those are the million-dollar questions. Execution is everything.
Absolutely. And of course, there's always the unpredictable nature of the global economy. External factors like a global economic slowdown could impact India's trajectory, regardless of how sound their domestic policies are.
External factors are always a wild card. So a lot to be excited about, but also a need for realistic expectations and a recognition that challenges will inevitably arise.
Precisely.
Now let's shift our focus to the investment landscape. We touched on this earlier, but let's dig a little deeper. What's the report's overall take on investment in India in light of this new budget?
Morgan Stanley remains positive on Indian equities, particularly small and mid-cap stocks, also known as SMID stocks. They believe these companies are well-positioned to benefit from the anticipated growth in both consumption and Capex.
Because they're more closely tied to the domestic economy, right? They're not as affected by global fluctuations as larger multinational companies might be.
Exactly. They're more directly impacted by the growth happening within India itself.
What else do they highlight in terms of the investment outlook?
They're also optimistic about the potential for increased foreign direct investment, or FDI, and a generally improved outlook for private investment in India.
What's driving that optimism? Is it simply a matter of a growing economy attracting more investment, or are there specific factors at play?
It's a combination of factors. The various tax reforms included in the budget play a significant role in creating a more attractive environment for investors. And they also hint at the introduction of a new tax code in the near future, which could further enhance the investment landscape.
So streamlining the tax system and making it more investor-friendly is a key part of their strategy to attract both domestic and foreign investment.
Exactly. They're sending a clear signal that India is open for business and ready to welcome investors who want to be part of their growth story.
Now, we've talked about the potential positives, but we also need to address those concerns about income tax collection. Can you elaborate on why Morgan Stanley is a bit skeptical about the government's projections?
The government is expecting income tax collections to grow by 14.4% in F2026. Which is quite ambitious, especially considering the significant income tax cuts we discussed earlier.
It does seem counterintuitive, doesn't it? Reducing taxes while expecting higher collections. How do they reconcile those two seemingly conflicting goals?
Their projection hinges on the assumption that the tax cuts will stimulate economic growth to such an extent that the overall tax base expands dramatically. Essentially, they're betting that a rising tide will lift all boats, leading to a larger pool of taxpayers and ultimately higher collections, even with lower tax rates.
So they're counting on a significant multiplier effect from those tax cuts.
Yeah.
Does Morgan Stanley buy into that optimistic outlook?
They're a bit more cautious. They believe the government's assumptions might be a bit too rosy, and that achieving that level of interim tax collection growth could prove more challenging than anticipated.
So it's a key area to watch as this budget is implemented. If income tax collection falls short of projections, it could throw a wrench into their plans for fiscal consolidation and debt reduction.
Absolutely. It's a critical piece of the puzzle that could make or break the success of this budget. It'll be interesting to see how this plays out in the coming months and years.
Well, we've covered a lot of ground in this deep dive. We've explored the budget's goals, its key strategies, those four engines of growth, and the potential implications for both the Indian economy and the investment landscape. But before we wrap up, let's take a step back and distill some key takeaways for our listener. What are the most important points to remember from our discussion so far?
I think the key message is that India is at a pivotal moment. This budget lays out a bold vision for economic growth and development, but it also comes with a healthy dose of caution. There's a lot of potential here, but success hinges on effective implementation and navigating both internal and external challenges.
Excellent point. And for our listener who's perhaps wondering what this all means for them, what's the one big takeaway they should walk away with?
I'd say this: India is making a big bet on its future, and it's worth paying attention to how this gamble plays out. Whether you're an investor, a business owner, or simply someone interested in global economic trends, India's journey over the next few years will be fascinating to watch.
Couldn't have said it better myself.
Right.
Now, before we wrap up this deep dive, let's leave our listener with a final thought-provoking question to ponder.
Intrigued. What do you have in mind?
This budget is heavily focused on domestic drivers of growth, consumption, investment, infrastructure. But in today's interconnected world, no economy is an island. How will global economic trends, geopolitical shifts, and technological advancements shape India's trajectory? That's something for our listener to consider as we watch this ambitious plan unfold.
That's a great point. Domestic policies are crucial, but the global context can't be ignored. It's a complex interplay of factors that will determine India's ultimate success.
Indeed. And on that note, we've reached the end of our deep dive into India's F2026 budget. We hope you found it informative and insightful. Until next time, keep exploring, keep learning, and keep diving deep. We've explored India's F2026 budget in detail, analyzing its potential for growth and acknowledging the challenges ahead. Now, let's bring it all together and highlight the key takeaways for you.
This budget is clearly designed to stimulate both short-term and long-term growth. The combination of income tax cuts, to boost consumer spending and the substantial increase in capital expenditure for infrastructure development shows a commitment to both immediate impact and sustainable progress. It's like they're pressing the accelerator while simultaneously giving the engine a tune-up.
What's particularly intriguing is that they're aiming to achieve this growth while also emphasizing fiscal responsibility, with goals to reduce the deficit and bring down debt levels. It's a balancing act that requires careful execution.
Absolutely. And Morgan Stanley, in their analysis, raises some valid points that we should all consider. Is it realistic to expect that level of growth in income tax collection, given the proposed cuts? Will the government be able to effectively implement these ambitious Capex plans, ensuring that the funds are used wisely and efficiently?
Those are the critical questions that will determine the ultimate success of this budget. It all comes down to implementation, turning those plans on paper into tangible results. A blueprint is one thing, but building the structure is quite another.
Precisely. So for our listener, what's the key message to take away from this deep dive?
I think it boils down to this. India is positioning itself for a period of potentially significant economic expansion. This budget is a clear signal of their intent and their ambition. But it's crucial to remember that there are both opportunities and risks involved in any ambitious endeavor.
It's a bit like watching a high-stakes game unfold. There's excitement and potential, but also the awareness that the outcome is uncertain.
Exactly. And that's what makes it so fascinating to follow. Keep an eye on how the government executes its plans. Watch those key factors we've discussed. Income tax collection and Capex implementation. Those will be the true indicators of success.
And remember that India's story doesn't unfold in a vacuum. Global economic trends, geopolitical shifts, and technological advancements will all play a role in shaping India's trajectory. It's a dynamic and complex landscape, and that's what makes it so captivating.
Well said. And that wraps up our deep dive into India's F2026 budget. We hope you found it informative and insightful. Until next time, keep exploring, keep learning, and keep diving deep.